We also, did it just start?
Yeah, it
I
just
heard.
started. So sorry about that, everybody. Thank you for joining us on our webinar this evening on conducting due diligence on an investment. We're going to go ahead and get started. My name is Ryan Gibson. I'm the Chief Investment Officer with Spartan Investment Group. And we are so honored and delighted to have Kathy Fettke, co-founder and co-CEO of the Real Wealth Network. Kathy has done some amazing things in the space, and she is going to share her wisdom this evening on things that you should look out for as a passive investor when doing your due diligence on a specific investment that's in a syndication, and also looking into things on an operator. As you know, we had Russell Gray from the Real Estate Guys on a previous webinar, and we talked about doing due diligence specifically kind of on the operator holistically. And Kathy is going to dive into some specific deals this evening, and she and her company have done some incredible things. So without further ado, Kathy, why don't you go ahead and introduce yourself?
All right. Well, thanks for having me here tonight. I am just really, at the end of the day, I'm just a mom with kids. I'm about to be a grandma. But about 15 years ago, I really found myself in a desperate position and I wanted to figure out how I could make more money. And I needed that money to be passive. So I just made it my mission because I wanted to stay a stay-at-home mom. And I made it my mission to understand how other people have done it. So I figured if they could do it, I could do it too. And I had the Real Wealth Show radio show back then in San Francisco, which is now a podcast, still around 15 years later. And I would just interview wealthy people to find out their secrets, and it was very much personally motivated that I wanted to learn it. But turns out my audience wanted to learn it too. So we've grown to over 50,000 members at Real Wealth Network. We help really raise wealth consciousness of people because it's amazing how little people know about how to invest and how to take their hard-earned money and invest it safely. I mean, it's almost every day I hear a news story about someone who gave their money to the wrong person and didn't get it back. So, I'm on a mission to help more people know how to identify a good deal, what to look for, and, especially with the operator, so that they can really move forward safely and grow wealth.
Absolutely. And by the way, Kathy, I love your podcast. I listen to Real Estate News for Investors on a regular basis, and I think it's kind of like I don't know, I always use this expression, the BBC News of real estate investing. It just gets right down to the heart of what's going on from a macro level and often a micro level, because sometimes you focus on specific markets. And it's just really interesting to hear some statistics. So if you're not listening to the Real Wealth Show, and the Real Estate News for Investors podcast, definitely add it to your list. I like how quick it is. It just gets right to the point and talks about some great statistics.
Thank you so much. It was my husband who was like, "Man, you're babbling. It's going on for an hour. You might want to get to the point, 20
Yeah.
minutes max." And so I'll give the credit to Rich.
I mean, it might, you know what?
Exactly. And by the way, we just got back from Canada, Rich Fettke, Kathy's husband, and we had a great mountain biking trip. So we had a lot of fun on that. So
I heard Rich just went over a cliff and landed on his head, but walked away from it like normal. So thank you for sending him home safely.
it's a good thing that we were all wearing uh, a helmet and protective gear. So it was
Yes,
very, very good. So. Well,
yes.
anyway, without further ado, let's go ahead and jump into the webinar tonight. And I'm sure Kathy will appreciate this slide very much, but this is just kind of a legal disclaimer that we'll get out of the way, which is we're not offering advice this evening. Seek outside counsel. This is just a general overview, so seek your own advice, and information contained is subject to change, and obviously perform your own due diligence. So with that out of the way, before we get into this webinar, we're going to just talk about what webinars we have at Spartan Investment Group for the rest of 2019. You can see the check boxes. That's what we've done. We talked about operating agreements in a syndication, private placement memorandums. We did a deep dive on self-directed retirement accounts. We did how to conduct due diligence on an operator. And tonight we're going to go into some specific investments. And you'll notice that the theme continues on this webinar this evening on the team really being the most important thing when you're looking at a real estate syndication or a passive investment opportunity. Later on this year, next month and the following, we'll have a webinar. We do monthly webinars. The next one is understanding your capital account in a real estate syndication. And lastly, as we approach the new tax season, how a K-1 impacts your tax return in a real estate syndication. So tonight, it's continuing our themes of the Fire Festival, right? We have an expectation of getting an awesome deal or an investment, and then in reality, we do not get anything near what we expected. And that is essentially what Kathy and I are talking about this evening, is how a really good marketing package or really good marketing online or on Facebook, or selling you on a specific investment may seem attractive. Everybody may seem like they have their stuff together, and then next thing you know, you are in a disaster of a deal, and the marketing has fizzled off, and now the actual team that executes your deal is not there. So, and I did want to mention that all of these webinars are available if you go to our YouTube channel, and that if you go into YouTube and type Spartan Investment Group, you can see all of our webinars, property tours, updates, and please go in there and subscribe, as we're trying to get more subscribers to our YouTube channel. So with that, I always say we're going to hand it over to Kathy here in a minute, but risk mitigation starts with you. I love this slide. This is the Swiss cheese model that we use in aviation, which, there is no one thing that causes a deal to go bad. There's no one thing that causes an accident, and it's a combination of errors that line up that cause a massive loss. So usually this starts when somebody makes you a promise or a guaranteed return. Always run away from that. Lack of a business plan or documents, if they kind of glaze over, the documents that are provided, or needed or required in an SEC offering, or they say something like, "This is a once in a lifetime opportunity. There's never going to be a deal this good like this one, and you better act now, or forever hold your peace." That is a clear telltale sign to run. Or maybe they have no track record. And that may or may not be an issue, but when all these things kind of line up, you may have the perfect opportunity for a deal gone bad. So with that, I am going to go ahead and turn it over to Kathy.
Okay.
And I hope I can make this work, but there you go, Kathy. That you should have control over the slides.
Oh.
You got it.
Okay.
Awesome.
All right. So as you can see, I just ripped this photo off from the internet. So there's still
little things on it.
But so many people now are hearing that OPM, other people's money, is a way to build wealth in real estate, and it is. And they're being taught, well, you can syndicate and you can make all that money using other people's money. You find the deal, you make it work, and you give them the profit, and then you get a bunch of the profit too. So syndication has become a real buzzword. I'm seeing people teaching it all over the place. When I started, there was nobody teaching it, so I kind of wish there were people teaching it when I had to kind of figure it out. I'm paying lots of attorneys to help me. But the bottom line is, this is the dream. So you'll just be swimming in money, basically. I don't think it's moving. I'm not sure how to. Oh, it is. Okay. But this, again, is my incredible graphic design talent. But this is unfortunately where so many people end up. And I do mean so many. I can tell you in the next, I believe in the next slides, the people that I've been on the same stage with. I saw somebody get arrested on the same stage I was on. They came in and arrested him and pulled him right off the stage. And people that I've known that seemed perfectly fine have gone to jail because they did not raise money correctly. So it's really, really important, if you're going to syndicate, that you understand the rules. And if you're going to invest in somebody's project, the main thing you have to risk is your money, but boy, you don't want to lose that. So there's some key points you just need to be aware of. And I think Ryan just kind of mentioned some really important ones, but we'll go into a little deeper dive here. Yeah, I think it's not.
Let's see if it Sometimes it's just easier. There we go. Perfect.
Okay, so here's one example. Terrence Brown, he was the owner of Bay Area Equity Group in San Francisco, charged with $3.5 million fraud. Many of the properties portrayed as, in great condition, turned out to be dilapidated homes in Detroit. According to the Santa Clara County District, some were sold to more than one victim. So he'd basically sell one house and then sell it to another, same house. The title was never transferred, and he guaranteed that 15% return. So right off the bat, this just happened to a Fox News host, by the way, too. He was apparently selling dilapidated homes in Detroit. Whether he knew it or not, he's in trouble now. So here's, when looking at this, there's two parts. One is that investors didn't do their homework because they bought a property and didn't get on title. That's a super easy thing to figure out, go to a title company, you have them do the title. So even just a very quick Google search on how to buy a property would have told you how to do that. So investors need to kind of take responsibility for not doing their due diligence, but also in this case, I'm not sure if this company started out thinking, hey, I'm going to take money from people and, figure it out later how I'm going to pay them back. I think it's more the way I heard it is that they made this guarantee of 15% return. They couldn't hit it. So they started that Ponzi scheme thing where it's, okay, well, I'll just take it from this investor and I'll pay that investor. And in the end, it'll all work out. So no one will ever find out. That's often how Ponzi schemes are started, not necessarily with people thinking, I'm going to open this business to commit fraud. It's more like, uh-oh, I made a promise I can't deliver. I'm going to have to cover it up, rather than just talk to the investors and say, I messed up, we're not going to hit this return. So again, it's kind of up to the syndicator to be super honest. Real estate does not always go as planned, and just to communicate what's happening. But also, as an investor, a guaranteed 15% return, where are you going to guarantee that? There's no guarantee in life. The only guarantee we have was taxes and death. So don't listen to guarantees. All right.
Absolutely.
So the next slide. All right, here's another Shawn Watkins. This one kind of shocked me. I mean, they all shock me. I see these all the time too. Equity Growth Group. Interesting that they all have equity in their title, but he ran a real estate investment club in Orange County, and he and his wife were at all the same events I was at. People would be really good quality speakers would come to their clubs, and they just really built trust with their investors, just like so many of these meetups and events that you go to. So again, the same kind of thing happened where now he had kind of built all this trust, started a fund, told people to invest in it, and it basically, investors were led to believe they would receive substantial interest payments and their money would be secured by collateral through the filing of deeds. Those deeds were never filed. Just a little bit of due diligence would have protected those investors. And I don't know if this was his intention starting out, but I do know that a friend of mine said that they bragged a lot about their fancy cars and their nice house. So I don't know. I don't know. But again, this is a case of investors can't get their money back. So even if this guy's in jail, still the investors aren't going to get their money back.
It's really good too. I mean, recorder, the deed of trust should be filed with the recorder of deeds, and that's publicly made information. So,
yeah,
if you're ever into a deal that you're, lending money to a property and that there's a promise to be a deed of trust, I think it's really important to verify that. So as soon as the money goes over and, there was a promise to put yourself on a deed of trust or a promissory note, that's typically recorded against the property. And that's something that you could verify through a title search, through an attorney or through a title company, or just going into public record and seeing the actual document recorded against the property. So, just a tool for your tool belt when you're thinking about investing in, somebody's debt. You should always have a security against something if it's a debt position.
Yeah, and again, yeah, if you're secured against the property, that is easy to look up. And just, the bottom line is there's title companies that do that. So make sure it's all going through title and escrow, always. Oh,
Always. That's a great point.
all right. Now, Phil Carter, this was a friend of mine, Texas Cash Cow. He started out doing really great work. He was helping investors find foreclosures, and he'd fix them up, and turnkey properties. Basically, he had the property management under his control, and I mean, just nothing but rave reviews. So same thing, just really built incredible. He actually had a track record in turnkey, and our investors really raved about him. And then I don't know what happened. I don't know what happened, but something did. And he started to do deals that were no longer that. He was buying apartments and then selling the units one by one to investors. So investors each owned a unit, like an apartment unit in the apartment. I don't know how he pulled that off, and I guarantee you there was no recording for that because he would have had to turn it into a condo. So people thought they were buying, one of the little apartments in the apartment, but they were just basically giving him money. Again, they, didn't go through title. So I lost touch with Phil, and then I saw this, and I was bummed to see it. So basically, the SEC complaint states that Carter used investor money for personal reasons, including $800,000 in cash withdrawals, $124,000 for a private jet, $39,000 for Dallas Cowboy tickets, and $500,000 in cash transfers. So, the bottom line is money's fun, right? You can do a lot with money, and you have to be someone with incredible self-control when investors are giving you millions and millions of dollars. It needs to go to what the investors, what's written in the documents, what the agreement is. It is not, I don't know that investors would invest if that agreement said, as part of this development, I'm going to be flying on private jets and I'm going to be taking clients to the Cowboys, and I need to pay my tax with it. That's misappropriation. So whatever the deal says, the use of funds, that's where the funds need to go, period. You do not spend it on yourself. The deal goes well, spend it on yourself when you get the profit.
Well, and here's the thing too. I mean, a previous webinar that we did was on the operating agreement, which talked about specifically what in a syndication the use of funds can be used for. So, review that webinar. That really gets into the heart of it. We had Mauricio Ruled talk about, setting up the operating agreement and how really that's kind of the heartbeat of the deal. When you go to the operating agreement, it'll tell you what you can use those funds for and what you cannot. And, if you ever do suspect that you may have gotten yourself into a bad project, ask for the financials, ask for the P&L and the balance sheet. That will tell you a clue, and then maybe ask for a bank statement to accompany to support the balance sheet. If there's any hesitation whatsoever, things can be redacted if there's personal information in there. But that might be one way of kind of finding out, if you have, gone into this deal, and you've seen it on Facebook, oh, this guy is a great operator and a marketing genius, and he's raising all this money. And then you see him, driving around in a Maserati, and you wonder, I just funded this deal, and now he's driving a Maserati.
I drive a Chevy Volt, if that gives.
Right. That's kind of a quick, there's nothing wrong with people driving nice cars and things like that. But when you see the instant excess in personal life, endeavors, it's something that, may wave a little red flag, especially if you're not really hearing much about your investment, or maybe it's not, performance never doesn't really flag that it's doing really well or not doing really well, but you may have that, kind of some of the signaling, and make sure you are, kind of checking up on the health and the financials of your project, on a somewhat regular basis. And there shouldn't be any operators that have too much stress doing that, because you can't really do your tax returns without your books, right? And you can't really operate your business without having, books and, bank statements and things like that. So just something to think about.
Yeah, absolutely. And unfortunately, once you've written the check, you can't get it back, if they've spent it. So, the importance is to do all your due diligence before you write that check.
Absolutely. So let's talk about Riverscape.
Yeah, I'll tell you two projects that we did when I first started syndicating. And again, I had no guidance. I had to figure out syndication on my own. I hired the best SEC attorneys to walk me through it, but I didn't have the kind of resources that people have today. So basically, at the time, it was 2009 and the world was falling apart. It was, real estate had, fallen 75% in some of the markets I was in. And, people were just trying to tread water. It was a very difficult time. But right about then, I got a call from one of our Real Wealth Show listeners, and turns out he was partners with a very established developer in the San Francisco Bay Area. And he said, you really got to meet this guy. So I drove out to Carmel, and I met him in his big, gorgeous home. And, he did have all those things. He had a private jet and a yacht and all these things. But, he was an older man. And so I asked for his resume, and we did the research if it really was him that did all these projects. But sure enough, many of the projects I would drive by every day were built by him. So basically a 40-year track record. Well, maybe it was 30 at the time, 30-year track record. And so he passed the test of somebody who probably didn't want to lose all those things, very, very professional, 30 years, nothing negative about him online. So anyway, he said he found this project in waterfront in Portland called Riverscape, but because the banks had failed, and even though the project was great, it pretty much just looked like this. But the interiors weren't finished, but the construction loan just went away, because back then liquidity just literally just disappeared. Even if you had a construction loan, you didn't get your payment, like you didn't get your money. So this went into the bank failed, and the FDIC took it over, and the FDIC doesn't want to do development, didn't want to finish it off. So this guy was able to buy the whole thing, 26 waterfront townhomes for $3 million, formerly $12 million, 70% complete. There's no financing available. So he just said, can you raise $3 million? Turns out, one email and we had it raised. So it was very easy to raise for, and that's when I kind of learned. And this project seemed pretty simple. It was like, buy this building, already finished, 70% complete. We have the money now, we can finish it. Why would that be difficult? Well, when we finished them, there was absolutely no financing for the buyer. So we had 26 waterfront townhomes, but by the time we were done with them, it was the double dip recession, and there was no money. Like, people couldn't borrow it to buy it. So we ended up, this is when Fred's expertise kicked in, and so anyone can do an easy deal. It's just that there's no such thing as an easy deal. There's always obstacles, always. And that's when the experience comes in. It's like he knew how to navigate. And then it turns out, because some of the former units, some units in the building next door, which were in the same HOA, well, there was just a bunch of foreclosures, and, it was crazy times. So there were all these HOA lawsuits and all this craziness. And so, he was very clear, these people, our buyers, will never be able to buy these units if there's HOA lawsuits. So we had to create a new HOA and get out of that one. Then we found out that the GC, the general contractor, was stealing from us. So he figured that out, and he sued him, and he knew how to get the money back, and just basically lots of obstacles. He knew how to get through them. He maneuvered it very well. Investors ended up with a 22% annual return during the worst part of that Great Recession. So here, it's kind of like, Ryan, you're a pilot. If someone's getting on an airplane, let's say it's a small one that, you need maybe more savvy to be able to fly, probably anyone with a license can fly it on a blue sky kind of day. But when the winds pick up and the storms come, boy, you sure want that person who's got a little gray hair, who's flown through storms before, right?
Exactly. And, I'll never forget the story of being that young pilot and flying with another person who was about 23 years old. And we kind of looked at each other and said, we should just keep that door closed to keep the comfort level up in the flight deck. But no, now that I've got over, 10,000 hours of experience, my experience has paid off. And obviously, the same is true here. If you've got the experience on your team, and we've talked about this in previous webinars, sometimes it's okay to take a chance with an operator that maybe doesn't have a huge amount of experience, but the sort of risk-adjusted projections and the return, the cut of the deal should feel in line with their experience. Maybe a great deal, maybe they don't have as much experience, so there might be some bumps and bruises. Over having, a guy like, in your project, a guy in your team at Real Wealth that can navigate through some of the challenges by having that experience. Now, on the other hand, I always say that people can have 10,000 hours of experience, or they can have 10,000 hours of experiencing the same hour. So there's a difference between there's a difference between, having good quality track record of experience and not. So, when I talk to a lot of investors, I say, listen, if when you talk about real estate development with an operator, and they come off as nothing's ever gone wrong, everything's always been successful, never had any issues, run far and run fast and run the other direction as quickly as possible, because these deals there's bumps in the road, there's challenges, there's things that go wrong with these projects. And it's having the team that can respond and react to those challenges. I mean, we've had everything from properties to catch on fire to people living inside, self-storage units to, financing being pulled out at the last minute. And you just have to have the team that goes, oh, another challenge, how do I overcome it? And having the experience coupled with the ability to navigate through challenges is very good. So very, very good point. All right, let's talk about Chateau Montclair.
Okay, so that was such an incredible success. People started talking about us and telling other people. And so I had another developer come to me and say, hey, I got a similar deal. 9 homes in the Oakland Hills. This pains me to even talk about this. Oh, gosh. Chateau Montclair, what could go wrong?
Right, exactly. I mean, we had a chateau as well. We had a chateau deal, and investors made a profit, but yes, there was a lot of interesting bumps and bruises on that one. So anyway, go ahead.
Yeah. So chateaus, be careful. But 9 homes in the Oakland Hills. I knew the area, beautiful area, overlooking the bay, overlooking the bridge, just fabulous, perfect, like A+ schools, no crime. We loved it. It was IndyMac had the loan on it. IndyMac failed. These properties were repossessed. The guy couldn't complete them. Same reason. Almost everything was the same. So I was like, oh yeah, we've done that. We're good at that. Let's do it. Same thing. I raised $3 million practically overnight. City of Oakland said, hey, we want this done. Yeah, let's do it. So our due diligence was done. It was great. The difference was that the operator, the developer, had never done this type of project before. He had been an expert in flipping homes. He had been an expert in fixing them up, in notes. So lending, like he had a lot of expertise, but what he didn't have was the experience of taking a subdivision that isn't complete, that's never had its certificate of occupancy, never been lived in, never completed. He'd never done that. Now, it was 2010, so it's like, it's not every day you have a foreclosed subdivision. So you could kind of understand, well, how could he possibly have had experience in that when, that hadn't existed really. So the difference was the first developer, Fred, on the Portland project had 30 years experience. The guy on this one he was young. He was a younger guy. Again, no offense to anyone young. He just hadn't developed property from ground up necessarily, and he'd never worked with Oakland, which is just whoa. So so the city of Oakland came to the project and said, okay, we see that, and originally in our due diligence they were like, yeah, let's get it done. But back then the market had fallen, the city workers, there was no funding. So city workers were working 2 or 3 days out of the week. So like just even to get them to talk to you was a chore. But they decided, or they had their city attorney decide, you know what, since this was a project that's foreclosed on, we don't really know what's happened during that time period. So we're going to really inspect it, even though all this stuff has been signed off. So they came back and said, we can't find the sign off on the piers, basically, which protect the house from earthquakes and stuff. They're dug deep and hold the house up. They said, we can't find that proof. Can you get it from IndyMac? Well, of course, IndyMac didn't have it. And they're like, well, we're not going to let you sell these houses until you prove that these piers were done correctly. I'm like, well, it's in your book, signed off. It's, it's right here. It's signed off as done. It's been inspected. Like what, like where am I going to find the card that the developer would have? So, they're like, I don't know. You're just going to have to hire someone to dig down and make sure the piers were done. Fine. Okay, fine. We'll do it on one. They're like, no, on all of them. Well, there were like 100 of them, and it was like 10,000 each. It was going to be $1 million to do this or more. And in the process of checking to see if the piers were okay, every single one of them, it would have compromised the integrity of the piers. So it would have like made the buildings fall down. So, here we were. I don't know if any developer would have been able to figure that out, but it was like, oh boy. Well, the project came to a complete stop. We had to find the developer. He was nowhere to be found. 6 months later, we found him working as a waiter in a restaurant in San Jose.
Oh my gosh.
I'm like, look, we need you. We need this sign off. Do you have a box of stuff? He goes, yeah, 10 grand. I'm like, here you go. I write the check. Here's 10 grand. We got it. And walked out of there. I handed it to the city. They're like, okay, great. By then, we were 6 months into it. Now the project has sat longer. And in that time frame, the permitting process had changed. The building code had changed. So they said, oh, well, now your permits have expired. Now the building codes have changed. You're going to have to retrofit the entire building to the new building code. So they came in, they looked at little things like the staircase. And they're like, oh, it's 1/32 of an inch off with the new building code. You're going to have to tear those stairs out, redo them. Bottom line, it was just a nightmare. The GC stole from us also. The difference is he sued us. Remember in the other deal, we sued him and got our money back. He sued us because the developer fired him as soon as he found out that things were stolen, and the GC came back and said, well, the contract says you had to give me 2 weeks. So not only did he sue and win, but he got a big sum of money. So it was just everything that could be difficult. There was an investor whose wife who died, and the wife took the inheritance, and she wouldn't sign docs that needed to be signed, and it delayed the project by another, I don't know, 3 or 4 months. In the end, the investors made no profit. So 2 very, very similar projects, one that was a winner and one that wasn't, and I can only assume that it was the experience of the operator that made the difference.
Absolutely. And, and I think that's so important is, especially, when you look at these, see what due diligence has been done as well. What tests and studies, and I know that the code changed throughout the process, but when you're looking at a project, I mean, think about this story that you hear tonight of, just a stalled project and the experience of the person behind it, and their ability to get it done. And thankfully, the Real Wealth team had the experience to kind of get it to the finish line, which I think really kind of made the difference. Sometimes, in these partnerships, the folks on the capital raising side of the house, or part of the team that sort of assembles the deal and puts it all together, they may not have any experience in investing in apartments or building houses or doing these projects. And even though the developer maybe in this case didn't have the experience, at least Real Wealth had the experience to kind of take it to the finish line and get it done, right? I mean, it seems like, yeah, there is no profit, but I'm not sure what the return of principal invested was, but at least it sounds like some of it was recovered in the end to get the deal done. So
yeah, but it took the years of my life were never recovered that I lost to this thing.
Well, hey, that's what we get. That's what we get paid and rewarded for eventually, right? Is all the years of lost deals and things that don't become deals that we spend time on and things like that. So
yeah. So
let's talk about this. I like this capital stack slide. This is something that we haven't really talked a whole lot about in our webinars. So take us through the deal structure and the capital stack. We do things a pretty similar. So this is a great slide. Let's talk through it.
Well, this is part of my mission to help raise the intelligence of people who, of investors, because we have preferred returns in our in a lot of our PPMs, and I can't tell you how many times, 6 months down the road, someone's like, "Where's my interest payment?" And it's like, "Oh, okay, let me explain this. Let me explain this. This is really important for you to understand the capital structure, otherwise known as the capital stack." So in the private placement memorandum, it describes the deal, what the developer's intending to do. They may or may not hit the mark. Not every deal goes well. Like, you have to understand that as an investor. We're just, developers are just doing their best, but anything can happen. So you're taking risk, but it's got to be calculated risk. You want to make sure you minimize that risk by investing with the right person in the right area, with the right project, the right timing. There's a lot to it, and with the key being track record, because if they've done something for many, many years over and over again successfully, there's probably a pretty good chance they don't want to lose. They want to keep that momentum, and they've got the experience. So capital structure basically is defined in the PPM and the private placement memorandum and the operating agreement, who gets paid when and what order. So at the very bottom, you'll see the secured debt. That's the lender. That's the person who, let's say Ryan and I buy a house together for $100,000 and we want to put $50,000 into it to fix it up and sell it for $200,000. We've made $50,000. Well, who's going to get it? Have we defined that? Maybe Ryan worked more than me. How are we going to split that? And even worse, what if we bought the house for $100,000, put $50,000 into it, and sold it for $100,000? We lost $50,000. Who's taking that hit? Who gets paid? Who gets paid the remaining money? So this is all supposed to be defined very clearly before you go into any agreement with anyone, even your own family. I did my very first house. We made an agreement with my dad, and it was kind of like, okay, we'll cover all the costs, but we get the upside. He's like, yeah, and we talked about it, shook a hand. And then in a year, the house went up $100,000 in value. And my dad kind of forgot the agreement. And he's like, yeah, let's split the profit. And it was like, that wasn't the deal. But we didn't put it in writing, right? Love my dad, and everything's fine. We worked through it. But, you've got to define how it works, or it will get confusing. And that's why it's so sad. Oh, it breaks my heart when I see families fighting over inheritance. Parents, spell it out, man. Put it in the trust and spell it out so your kids don't have to fight over it. It's very, very frustrating. All right, moving on. So,
and just real quick, for the purpose of no investor left behind here, the capital stack refers to the total capital that's used for the investment. So that's everything. If it's a $12 million project, there's $12 million in the capital stack. So you can see kind of the arrows that make up the different layers of the capital stack. So there's debt, unsecured debt, equity, preferred equity, and then all the other equity that's in the project. So
thank you. No, I appreciate that. So secured, if you want the safest investment, you don't want to take risk. You want to be down there in secured debt. So secured debt, especially if it's at a low LTV, loan to value. So if the property is worth $100,000, again, I'm using small numbers, and you have a loan secured against the property for $50,000, you're probably in a pretty good position. Like, that property would have to go down in value by 50% for you to lose money. So secured debt basically says, if you don't pay me back my money, I take the property, and I have the first right to do that. If you're in first position in that secured debt, if you're in second position, you get to be second and third and so forth. Now, there's more that we could go in there with mechanics liens and tax liens and where they come into that, which they do come in pretty high, and even HOA. But secured debt is the most secure of debt. Unsecured debt would be, okay, well, I'm going to lend to this project because it needs rehab. And so we can't really secure it necessarily. We're just going to lend to the LLC in an unsecured debt position. And so after the secured debt is paid, then we get paid. And then you move into equity. And the equity is kind of like I said earlier, if Ryan and I were doing a deal together, bought a house for 100,000, put 50,000 of work into it, and there was a $50,000 profit, we sold it for 200,000. The equity is the $50,000 profit. Well, I guess it depends where that money came from, right? But let's say 100,000 was secured debt, 50,000 was unsecured debt to do the renovations, and then there was that $50,000 of equity profit. So the secured gets paid, the unsecured gets paid, and now there's 50,000. The preferred equity gets paid out first. So if Ryan said, I'm going to do most of the work, so I want to get paid my part first. I want $25,000 for my time, and I want that first. Well, if we sold the property for $175,000 and there was only a $25,000 profit, that would all go to him because he's preferred and it's spelled out. And then equity is everybody else. They get what's left and it's split. So again, secured debt, the most secure, also generally the lowest return because of that security. Unsecured debt, little higher return. Preferred equity would be, again, a little bit higher return generally. And then the regular equity people who kind of get paid last, they're the ones who stand to profit the most. If that property sold for $300,000, then the equity partners are like, yeah, we get all that. The secured debt just gets their interest of 6%, 8%, whatever it is, but we got a 40% return because we got all the rest. But if there was no profit, they could get nothing. So very, very important.
And to break this down into kind of some Spartan deals for those investors that are on the line, secured debt is all those folks that invested in the goldenrod debt. So they are secured against the property. There's a deed of trust and a promissory note in place recorded at the county level. There is no unsecured debt in the property. And then the other thing that we use in here is the preferred equity partners. So on the equity side of goldenrod or Aspen Park or Mini West or any of the other deals that we're doing, we actually are doing preferred equity. So that means that there's equity partners that are paid a preferred rate of return before the general partnership gets paid. So just to kind of break that down, we usually have a preferred equity structure and a secured debt structure if we're doing a private raise with secured debt. So just to kind of bring it into kind of, to the real deals that are currently funded and in progress. Perfect. So let's talk about this Reno project. This project was structured so well. I've heard nothing but people rave about how awesome of a structure that Real Wealth put together to do this deal. So anyway, can't wait to hear about it. Yeah.
Thank you. Well, it's funny because like I said, I never had a mentor. I had to figure this stuff out myself. I went and I would talk to everyone I could, like, how do you structure? But it's not like there was this, at least I didn't know of a school that you could go to that there is a lot more information out there today. So I would just guess, I would think, well, what do you think? I wonder what my investors would like. That's how I structure deals.
Well, and I love this project because, in the last downturn, people had really great projects. They had really good, developments. They had really good, capital stacks. Everything was set to go. And then when the economy turned, they called their bank and they couldn't get a loan. And I think that's what makes this so unique is the risk reduction that you put together here so that this project could be kind of incrementally built, in a way that mitigated risk. So anyway.
I appreciate that. Yeah, because those, that Portland deal I showed you earlier, nothing wrong with that project. That was a great project in the coolest part of town on the river, the right price point. But when the banks collapsed, the construction loan he was counting on literally just wasn't there.
Yep.
So, and if, on the flip side, if let's just say the market slowed down and he had the loan and he couldn't sell units as quickly as he thought he could, they'd call the loan for that too. And they take the project and all the equity in it. So these equity investors would lose everything if the bank defaulted.
Absolutely.
So it's important to really understand debt. And I was going to say on the slide before, if you're the equity investor, you want to make sure you really understand what is allowed for debt, because you don't want the the developer to be able to just keep taking on more debt that comes in priority to you.
That's
So
such a good point. Like, can they put a second lien? I've even seen third liens, kind of go wild. Is that what you mean by that?
yeah, yeah. So it's like that should be well defined in the operating agreement and the PPM where they have to stop, because it's eating up your equity every time more debt comes in.
Absolutely. Totally agree.
Yeah. So on this, um, my partner is the same guy on the Portland deal. He's just a genius. He's just a deal maker, and he's amazing. And again, those years of experience, he kind of figured out on his own many years ago, because there was no one teaching him how to be a developer. So he just had to get creative. But on this, he's close to 70, and he's not in a mood to have stress in his life. He just wants to only do deals that are great. And he knew Reno was a hot market, so much job growth, and but people just driving prices up, just was a land grab there because there's such a need for housing, and he wasn't going to pay too much for land. That's something he's very clear about. So what he did find was a group of people who bought a very nice parcel that took a hard money loan. They had done all the entitlements, but the entitlements took too long, and the hard money loan was due, and they had no choice but lose it all. And equity investors lose everything or sell it. And Fred was able to get him to sell it, and he got an amazing price. So the price was right, and that's the only way a deal like this is going to work. So he came to us and said, all right, we need to raise $12.5 million to purchase the land, and we're not going to take on any debt at all. No bank debt whatsoever for building, because for a few years now, we've really not known, are we going into recession? Are we not going into recession? People keep saying there is one. We're at the tail end. I still think probably in the next 2 to 3 years, there could be one. So there could also be more growth. We just don't know. So we have to kind of tread carefully at this stage in the economic expansion. And he just did not want to be in a situation where the economy slows. He's got a bank loan. He can't sell these homes fast enough, and he can't make those payments, and be in a stressful situation owing investors $12 million, right? So we decided to raise enough money to buy the land for cash, and then sell half the lots to some of those builders. As I said, the builders were looking desperately for land. We were able to just do a little. I think there was just one final thing needed in the entitlement process. We got that done, got the final map, put it to market, and a large public builder said they buy the blue lots for $12.5 million. So basically, that was the price we paid for everything.
Wow.
So all the aqua colored and the orange ones we would own free and clear. So that sounded pretty great, and that was the plan, and all our investors were happy. But then Fred slept on it, and he goes, I I don't want to sell this land to them because there's no other land in Reno. So how about we just compete? We'll get a better price than, I think it was Pulte. It was one of the big names. And we could do another syndication and just buy it from the first group of investors, because again, simply because there's no land up there. So we did, and we raised another 12 million to buy that. Now that's it's sounds confusing to have one investor group buy from the other investor group, but the difference was these were affordable, these blue ones. The aqua ones are a little more high end, and the blue ones are just flying off the table because they're affordable. The aqua are just selling, steadily, but they're higher end, so it's not quite at the rapid pace of the other one. So, but the bottom line is this is all cash. Every sale of phase one goes to fund phase two, which then goes to phase three, and no debt. So it's just a very low risk way, no bank debt. But in the process of raising money for the second round for the blue lots, I realized that there were a lot of self-directed IRA investors who didn't want to come in it as an equity position, because basically the way the IRS sees that is that you're a partner with the developer. So you're in the business of building homes and selling them. And that's an active business. So if you do that in a self-directed IRA, that's a passive business, then you could be subject to UBIT, which is unrelated business income tax, and you could get taxed pretty high on the profits in your IRA, which is kind of not the idea, right? You don't want to pay taxes.
So we had a whole webinar with Clint Coons on that.
Okay, good.
So about one webinar ago. So if anybody wants to dive deeper into that, that is available. And anyway, just wanted to make mention of that.
Listen to that. It's important because you need to understand, always talk to your CPA before investing in anything. And many would not even begin to understand this. So it's great that you're learning here. Then you can tell your CPA and they can look into it. But so basically, we created a debt option because lending is passive. You're not in the business of buying and selling. You're in the business of lending money, which is passive. So we brought in a second raise that was just debt that would lend to the company, just like I said. Well, actually, we secured it. We secured it in first lien position. So that was really, really a nice deal, because I think we actually paid a lot for a secured loan in that deal. I'm not sure why we did. I think it was either 12 or 15% or something. They were secured at a low LTV on the property. And but for those people, those self-directed investors, they were able to get the profit without having to, pay that UBIT.
Makes sense.
Yeah.
Awesome. Great project. And that one is probably what, 50% built? How far along is it?
Yeah, it's really far along. You can just go to Meridian 180 to check out the quality of the project. It's won all kinds of awards, builder awards in the area, and just doing really well.
Awesome.
Oh yeah, there's some pictures of it.
Beautiful. Yeah. Look at that. That's a beautiful house.
Yeah, he goes really high end, even though these are the higher end ones, but even the more affordable ones, they look like this. They're really nice.
Great. Want to talk about Dublin crossings? Yeah,
I'll just do this real quick because this is harder. That one's harder to find. This was a way that we were able to entitlement is very risky. Entitlement means that you're buying raw land or some kind of land. In this case, it was an office building. And you're going to the city and saying, I'd like to build something else besides office. I want to build residential. Well, the same developer, came to us and said, hey, we see the plans for Dublin. They want to make this a live-work area. They want to totally redevelop it. This office building is old and dilapidated. The owner of the office building doesn't know what's happening in the area because I think it was an absentee owner. So they agreed that, on a $10 million contract sales price for the office building, but with a 2-year close. So that's one of the things that Fred does, is he always has a small deposit with a long extended close to make sure that entitlements happen and that very little money is at risk. So even though we were in a contract to buy it for $10 million, we only had to put up a $1.2 million deposit, which is still a lot of money, but with a 2-year close, just in case it took us longer to get the entitlements. And you can only do a deal like that with someone who maybe hasn't done the research or doesn't know that the whole area is about to be redeveloped. So we were able to rezone it to residential, and all the office tenants had agreed to leave. But in the very last minute, one of them couldn't find a new space and just said, you know what, we're not going to leave. And their lease, allowed them to stay. So we couldn't follow the plan of tearing down the office building to create, to build homes. This was a big problem. And we tried to bribe them, give them, not bribe, but just pay them to leave. They wouldn't leave. So again, with the experience of, an experienced investor or developer, he said, well, we're going to build homes. Why don't we just take a couple of those lots we were going to build homes on and build them a new building? They agreed to that. It's Challenge Dairy is the butter that, the dairy company. We built them a beautiful new building on some of the residential lots. The city was thrilled to rezone what we had zoned residential to back to commercial for that section because they were happy to keep challenge dairy. So it's again all about the relationships with the city when it comes to entitlement and really giving them what they want. So that was this workaround that I think a lot of other people might not have been able to figure out. And at the end of the day, that $1.2 million deposit was on the line, because we had to close. And we were able to pull it off, built the new building, rezoned the lots, did the horizontal, and sold the remaining lots for $20 million. We did like a double closing after 2 years, purchased it for $10 million, sold it for 20, and only spent about $350,000 on the entitlement. So it was pretty fat return. That's 38% per year on that.
Wow, that's amazing. It's amazing what an entitlement does. I mean, we have a similar project that we just entitled to build self-storage, and it's amazing the value creation that happens as soon as you get those approvals in the raw land, just itself. So great job.
Thanks. And Costa
This is
Rica,
interesting.
yeah. So this one was a little bit out of our normal, normal thing, and but I really trust the developer. He's a New York City developer, and he had done some resort type properties. He'd never built anything in Costa Rica, but he had a very close friend and partner who was a big developer in Costa Rica, so that's why I was willing to kind of go forward with it. And we were able to buy 800 acres in Costa Rica for I think it was $3 million. Maybe it was 4 million. Yeah.
Wow.
So incredible. And this land, as you could see, it's kind of doesn't have any trees. So a lot of people, entitling land is not easy, and you really need to know what you're doing. And in Costa Rica, they have such strict laws, environmental laws, that you can't cut trees. So if you look at all that land sort of in the background, there's trees, and you can't remove that. So it's really hard to develop land in Costa Rica. The land we bought didn't have any trees. So it was like, oh my gosh. And the city was excited about it. We got our entitlements, I think, in a month. And I don't know, maybe things are done differently in Costa Rica. Maybe there was a little behind the scenes stuff. I don't know. All I know is we got our entitlements very quickly. And we're developing an eco-conscious resort and residential community. It's, but it was scary because it's like, oh my gosh, we've never done this. But the reason I was able to move forward with it is because of the purchase price. 800 acres in this fastest growing part of Costa Rica for $4 million. It was just kind of like, worst case, we're going to be okay. We can just sell off lots. We can just sell the land. But in the process of getting everything in place, the developer said, I want a place for people to stay, to come see if they like the land and see if they want to buy a house here. So he built a glamping site, which is like really fancy tents with really nice beds and nice linens, but it's a tent. But this way investors could come and stay there and try it out. And it's also an income stream. So it's kind of like multiple income streams. And then part of the appeal of this eco resort is we planted 10,000 trees. That's one of the ways we got our entitlements, is we said, we're going to plant trees, and normally developers want to take them down, but we're going to plant them.
That's
and they
great.
all these organic, again, you got to know what the city wants. You got to give them that. That's how you get your entitlements.
Absolutely. Too familiar
right.
with that.
Yeah. So it's like eco-conscious is exactly what Costa Rica wants. Just, employing all the locals and, teaching the local bakery, hey, we're going to be ordering organic bread, and we're going to show you how to make it because we're going to buy a bunch from you, really helping the local community and stuff. But we also are, there's just so much, we planted so much organic produce that we just, our developer just went to a trade show, and we got trading partners. So now we're exporting the turmeric and the cacao and the coconuts and stuff. So it's another stream of business.
Oh wow.
Yeah.
That's really neat.
And we're making kombucha. It just sounds it's crazy, but it's like 800 acres of fertile land. You can do a lot with it. So
exactly. Yeah, especially in that region.
Yeah. And now a new international airport's coming in 20 minutes away. So it's a really cool project.
That's awesome. Well, we are talking about the value add strategies. So, kind of taking us home on some of the kind of the summary almost of what we talked about today. Kind of walk us through kind of what your investment strategy is at World Wealth and kind of what you look for, and some of the risks that investors are signing up for when they invest. And obviously
Yeah.
we saw the rewards today, but just to kind of be ready for sort of anything to happen throughout the course of an investment.
Well, deep value add is sort of what everybody's talking about and looking for. If you listen to my latest Real Wealth show with Ken McElroy, you'll see that people are thinking they're doing a deep value add, but it's already, there's nothing to add, and the rents have already hit the ceiling on some of these projects that people are buying. So make sure you're really buying at a discount, because you can't, make money if you're not buying it cheap. And that's hard to do these days because everything's expensive. Prices have gone up. And you got to really be able to improve the value. And on a multifamily, you've got to be able to increase rent. So just because you improve value doesn't mean you can increase rent. So you've really got to understand what the rents are in the area. No matter how nice you make it, if people can't afford to pay it, they're not going to. So that's another common thing we're seeing is people saying, oh, I paid four cap for this. We're going to improve it. Who's going to buy it?
Right.
Like, and if things soften a little, the way Ken explained it, you have to increase your revenue 25% just from one cap rate difference. I know I might have lost the audience on that, but bottom line is make sure you understand the local rents, the affordability, and don't assume that rents will only go up, because that's, it's not how it goes. Things go up, things go down. So there should be always some risk assessment. What if things do slow down? Rents could decrease. But if you get it right, you can sell for a profit or refi and make a bunch of money. So harder to do these days. Be very, very cautious about deep value add. That's why I think why Ryan, your company and my company, we're building, because it's hard to find
It's
distressed property because they've been bought.
It is. It's very
Yeah.
hard to find distressed property. And actually, we were fortunate enough on our last deal, the Fort Worth storage, to find such a distressed property in the Fort Worth market, at a
Wow.
time where prices are just, so high, because, it's just kind of insane to find something that was so, 45% physically occupied, buying it for
Wow.
$23 a square foot. It was, kind of an amazing opportunity. And those are the kind of opportunities that are just hard to come by. And like you said, really the value that you really have to create is by building it from the ground up. And,
Mm,
because the existing is just, there's just so much financing and funding in the market that's really pushing up prices. So let's talk about
absolutely.
your podcast. The Real Wealth Show, Real Estate News for Investors. If you're not already on your phone subscribing or following Kathy, please do that. You'll not be disappointed with the podcast. So,
Oh, thanks so much. Um, yeah, the Real Wealth Show I started when I was just desperate to understand how other people, made passive income, because I wanted, the story is that my husband was told he had 6 months to live when they thought melanoma had spread. He's healthy today and he's fine, and the doctor was wrong, but at the time I didn't know. So I wanted to figure out how, if I was going to be a single mom, how I would be able to take care of my kids. So I was just really desperate to understand, and I interviewed just millionaire after millionaire to figure out how they did it. And I'm still doing that today on the Real Wealth Show, just interviewing people and getting their success stories, interviewing economists, interviewing people like Harry Dent, that you may love him or hate him, but he's always got a perspective.
and every once in a while, you'll see Kathy on debating on national networks, right? I mean, you have been featured on several talking about the status of the housing market, right?
Yeah, Fox News and CNBC, and I'll be in New York, I think, next month, and probably be on some more shows. So,
No, no
uh,
big deal.
yeah, it's fun. It's
Yeah.
fun. It's
But
challenging because it's on those big shows. You've got to really, you're talking to a very big audience who maybe has no idea what you're talking about. So I have to really simplify.
yeah,
But
Google Kathy. She's been on some neat shows and has awesome debates about the status of the housing market and is usually correct on her predictions. So it's really great.
Thank you.
You're welcome. So this is the time where we open it up for questions. We're a little bit over the hour, but we have the opportunity, if you want to type in the question window a question to Kathy, to me about anything at all, real estate related. We're happy to answer those questions. I did see a question that we had earlier, which is, are these past webinars available to review? And they all are on our YouTube channel. So if you just type in Spartan Investment Group, you can see all of our previous webinars, property tours, and some other content that we put out just about how we do due diligence, how we do feasibility, hiring, and we kind of interview folks in the office to talk about different aspects of what our company does. And so this webinar will be posted to our YouTube channel probably within the next 24 hours as soon as the GoToWebinar downloads it. So you can review it again and tell your friends about it. So are there any questions? Let's see if I can get the questions box open here. Any questions from the audience? I see somebody had a hand raised, but no question. Jessica, did you have a question? If you wouldn't mind, just type it in the chat box and we can get it answered. Okay, great question, James. So how much of your due diligence is automated / on a template?
That is a very good question, and it is being developed further and further. So a lot of it is on a spreadsheet, and a lot of it is given to me from my partner, who is experienced developer. So he does a lot of it and gives it to us to verify. And then we also have a couple of companies that we review our due diligence documents with that are not too expensive. They're about between $75 and $150 an hour to just kind of review what we've done, because these projects are big projects. They're not things that I'm necessarily an expert in. I usually tell people, if you're going to syndicate, you should be an expert in what you're syndicating. And since I've not built subdivisions, I need to rely on other experts to verify.
Absolutely, and I will say at Spartan we have a templated checklist. It's grown to about 540 items. I'm happy to share it with our group. If you've invested in one of our deals, we share that due diligence checklist with you as part of the due diligence documents. And it's everything from doing a phase 1 environmental to a survey to a geotechnical study, property inspection, zoning, surveyor, going to the recorder of deeds of the county, talking and interviewing permit reviewers, things like that. So definitely make sure you understand the due diligence that was done before you do an investment. And Kathy and her team do a great job with that. And I'd like to say that I think that we do a good job with that, and making sure that the due diligence has been done and vetted before moving too far into the investment process.
And you guys really do an amazing job. You shared that spreadsheet with us, and we do use it, and it's a lot.
Thank you. Yeah. And there's and you look at the spreadsheet sometimes, and there's not things that are applicable to the deal. So to answer your question, James, a lot of stuff is templated and automated, but sometimes doesn't apply. So the key thing that I think we like to kind of further refine is, and catching me off guard a little bit, but basically the due diligence has to be, we have constraints, and sometimes we have questions that have to be verified. So if somebody says, you go down and talk to a permit reviewer and you ask them a question and they kind of just give you sort of a half-hearted answer, you can answer the question on your due diligence, but you really got to verify it on your own. So you really have to make sure you focus on finding the right answer, and an official answer at that. So we even further break that down and make sure that it's not just, well, I went down to the seller and they gave me the survey and they said the survey was correct. You've got to find you've got to obtain your own survey from somebody who's licensed and who is working for you, or that you can verify and they can sign off on it for you if you're getting a hand-me-down. So be really careful about that.
Yep.
Great questions. And I will say, the question of the automated, nothing is really ever automated. It's definitely process driven and templated, but it's a human interaction that's doing it. So, you don't just set it on autopilot and forget it. It's definitely something that you kind of march through one by one when you're doing due diligence. So important to make that distinction. Great. Any other questions out there for the group? Nylanders, thanks. Great job. Thanks for your time, Kathy and Ryan. No problem. Appreciate you guys joining us tonight. When investing in a new market, are you considering population growth, job growth, etc.?
100%. That's the most important thing that we look for is the job growth and the population growth, because real estate's really dependent on people, generally people who have jobs, right? So
Exactly.
You want to be in a growing market, definitely in the path of progress, ideally.
Yeah, and we actually, if you go to spartanmap.com, you can actually see all the markets that we focus on. And you'll notice that all the markets at spartanmap.com are markets that have population, job growth, and are MSAs where people are moving, and there's a mix of people in the path of progress, like Kathy said. We only look at those markets. So if we have a deal that comes in and say Oklahoma, not to pick on Oklahoma, but if you look at our map, we're not focused there. There's some other drivers that we look at, but for self-storage investing, one of the big drivers is, how much rent can you get per square foot? And we talked about that deep value add a little bit earlier. If you don't have the rent per square foot, which is driven mostly by population growth and obviously saturation, but that population growth, if you don't have it and you don't have the rent per square foot, you can't justify building new construction in those markets, and you can't justify doing the value add. So really, I know the Real Wealth team, you guys focus on very good markets and have done a lot of due diligence. And I think Real Estate News for Investors obviously will really ring that true, because that's basically what you talk about, Kathy, is different market trends, different data points that you look at. So very, very important, very critical. Good question. Thank you, Grace, for coming. All right, well, we don't have any other questions. If that's everything for tonight, we're going to go ahead and wrap up. Again, thank you for joining us tonight, and we hope to see you on the next webinar. Thanks, Kathy.
Thank you so much. Have a great evening.
All right, you too.
Bye.